Hi, I'm Thomas. Welcome back to the course Corporate Finance. Today's topic is reorganization. In the prior topic, we discussed liquidation. This is part 2 of bankruptcy. Reorganization is when a company files bankruptcy, but restructures, negotiates, reorganizes, and continues to operate. What's happening in a reorganization is there's a ranking of claims, as we saw with liquidation. A fully secured creditor is going to receive their claim in full, and partially secured or unsecured creditors will fall into a lower category. There will be a new category of liabilities, which is post-filing liabilities. Since the company is continuing to operate, might need some kind of financing while it's working through the reorganization process. So for example, if a company goes to a bank to get a loan or arranges accounts payable, a trade account with a supplier, the company isn't going to be able to get credit if they are in bankruptcy, and there's a chance that the new creditor won't be paid in full. So the new creditor has a special category where they have a priority over the old unsecured creditors to ensure that they're not lending to an entity that won't be able to fulfill this new obligation. So once a company files for reorganization, if they obtain any new type of financing, then that new creditor will be paid in full once the reorganization is complete. Shareholders continue to be shareholders, but their investment is negotiated down to a lower amount than the original investment. There are two requirements for reorganization. One is that assets are less than total liabilities. If assets were equal to or greater than liabilities, then there is no need for a creditor to negotiate their amount due down. So assets need to be less than liabilities, and the shareholders need to, the existing shareholders who own 100% of the company prior to the reorganization, after the reorganization, they need to end up with less than 50% of the equity. Well, who ends up with the majority of the equity? Those are the creditors who negotiated, and in place of receiving their loan or their liability in full, they're going to receive maybe some cash, maybe a new liability, maybe some equity. And the accumulation of this new equity needs to be more than 50% of the reorganized entity. Here's an example. We have our balance sheet as of the filing date, early 2013, and our reorganization date is about a year and a half later. The company is operating during this time. Of course, the balance sheet isn't going to be the same, assets, liabilities, or equity. There are going to be changes. So be aware that unlike a liquidation, we're looking at a situation where we have a bankruptcy filing, but we're going to continue to operate. And so during this reorganization period, there's some legal work, some negotiation going on, and so you'll be dealing with two different balance sheets, the filing date and then the reorganization date. Now let's look at, more interestingly, let's look at the liabilities and equity side of the balance sheet. We see as of reorganization, look at the equity accounts combined. If we combine capital stock and deficit, notice that these two together are less than zero. That is the first requirement, the requirement that assets are less than total liabilities. If we add up our total liabilities as of January 2013, these total to more than our asset balance. That's why we have negative equity. So that's one of our requirements. Now, once we settle at the final date of the reorganization, notice some things have changed. There have been some changes in the existing accounts, and notice these three new accounts that have come into play. Three post-filing accounts: short-term notes, wages, and accounts payable. So again, these groups are aware that the company is in bankruptcy. One group is employees and the other two are creditors. So they've agreed to work with the company to provide financing in one form or another under the guarantee that they will be paid in full despite the fact the company is in bankruptcy. They have a priority. Notice also that, as is to be expected, the equity situation has worsened. If we look at the retained earnings as of the middle of 2014, we have a greater deficit than we did when we originally filed for bankruptcy. That doesn't have to be the case, but that's reasonable. The company is not in a good situation, so things have continued to deteriorate here. So our plan, we're going to negotiate liabilities subject to compromise or subject to negotiation. Let's see what these liabilities are. I'm going to go back and write these liabilities in the left margin here so we can look at them as we do our analysis. We have accounts payable of $600,000. And what I'm looking at here is I'm looking at my balance sheet as of the reorganization date. That's where I'm getting these numbers. We have taxes payable. Taxes payable are going to be paid in full, so that's not really a number we need to look at for analysis. We'll just check that one. Next, notes payable, $260,000. Bonds payable, $1,290,000. Next comment, no adjustment to post-filing liabilities, those will be paid in full. And then the equity holders, let's see what we have here. We have capital stock of $500,000. That's what we're looking at. We're sort of saying the deficit is just gone. It's a negative value. The original investment of the equity holders was $500,000. And so these are the amounts that relate to the negotiation. So let's see what happens to the $600,000 in accounts payable. They're going to receive some long-term debt. They're going to receive some stock. Notice the amounts, $275 and $140, don't equal the $600,000 they were originally owed. That's the compromise. That's the negotiation. They're going to receive an amount that at this point is less than their original amount due. There is some upside. The stock, if the company comes through the bankruptcy and is stronger and grows and is successful, then the stock, of course, participates in that upside. So now this creditor has long-term debt. They remain a creditor, but they're also a stockholder and owner in the company. Taxes are paid in full. What do we do with notes payable of $260,000? We have some debt, long-term debt. And also we have some stock. Again, the stock of 60 plus a long-term debt of 120 does not equal 260,000. There's been a negotiation here to reduce those amounts. Bonds payable, 600,000 of long-term debt. So bonds payable was already a form of long-term debt. They're going to continue to have long-term debt, as well as some stock. Now, in this case, why the bonds payable we noted earlier, I'll go back to the previous slide. Notice in the description of bonds payable, secured by a building. Well, why aren't they receiving their payment in full? Because the loan amount, the loan amount is greater than the market value of the building. So when the building is sold, there won't be sufficient proceeds to pay the loan in full, and therefore we're also going to include this loan in the negotiation. No adjustment to post-filing liabilities. Our equity holders end up with $100,000 of stock compared to their original investment of $500,000. Now, the dollar amount of stock is less significant than the dollar amount of liabilities. And the reason for that is because at this point, really at any time, the amount of stock you own is a percentage of ownership in the company. And so without doing a complete calculation, just let's make a note here of where we have stock in this reorganization. We have the accounts payable holders with $140,000 in stock, notes payable $60,000 in stock, bonds payable $500,000 in stock, and these three total to $700,000. Comparing that to the value of the stock of the existing shareholders, $100,000, we have now met our second requirement. The prior to reorganization shareholders clearly own less than half of the company, and that was one of our requirements for reorganization. Let's adjust our assets to move them to fair value. This is what we anticipate being the valuation of the assets now. And we're not selling these assets, so we're adjusting the values based on the fair value. If there's a difference between book, then we make an adjustment to fair value, and we see the differences on the right with a total difference of $105,000 in negative. which is a loss on revaluation. We have to do some accounting for all of this activity because we're changing our balance sheet. So one of the important numbers in the accounting is this loss on revaluation. When we adjusted assets from book value to fair value, we see inventory and building went up, equipment and patent went down. The net effect is going to be a loss on revaluation of $105,000. We'll also need to make adjusting entries for these 4 individual assets that have a difference. We need to account for those differences on the balance sheet. We'll adjust our liabilities as well. These are adjustments coming through from the negotiations that we looked at a couple of slides ago. So let's see what the difference is. The difference is what we originally owed compared to what we now owe. And when I say what we now owe, there is a component of this that is common stock. So we don't owe common stock. We can say what we have replaced the old debts with is new debts in equity. And the difference between those two, $455,000, is our gain. This is also something we're going to include in our accounting. Gain on debt discharge of $455,000. Shareholders' equity also has an adjustment. We had capital of $500,000. The new capital is $100,000. So we need to make an adjustment to the capital account. We need to reduce the capital by $400,000. Now there's another adjustment to capital. That's the $700,000 of new equity that is issued to the prior creditors. In addition to that increase, there's a decrease of $400,000 for the original owners. Now let's look at the final accounting for the reorganization. We have individual transactions here that balance out to excess reorganization value, which we'll discuss in a moment. But let's look at the other items first. We've got a debit to gain on debt discharge. That came from slide 9. And then let's go down to the 4th entry. We have a loss on asset revaluation. That came from slide 8. So when we see here, there's a gain, which is a debit, and there's a loss, which is a credit. Something strange. Why are we debiting gain and crediting loss? It's usually the reverse. What we're doing in debiting the gain is we're reversing the gain. We recorded a gain on debt discharge by negotiating our liabilities down. That gave us a gain. And now we're going to close out that gain to this account, excess reorganization value. Gain is an income statement account. So we want to close that account out to this new balance sheet account that we'll talk about in more detail in a moment. So the reason we're debiting the gain is this is a closeout. We're going to close the gain account. Same with the loss. Why are we crediting a loss? We previously debited a loss on asset revaluation when we recorded the different increases and decreases to our 4 changing asset accounts. That gave us a debit to loss on asset revaluation. Now we want to close this account and get it into one final balance, excess reorganization value. Then capital stock, we have a debit, which is the normal way to reduce capital stock. That's what we're doing in this transaction. We're reducing the amount of capital stock for the existing shareholders. And then in crediting our deficit, that's going to adjust the deficit to 0. We're crediting an equity account, which increases the equity account. We have a negative, right now we have a negative balance in this equity account of $1 million. So to get it to 0, when it's at negative $1 million, we need an increase or a credit of $1 million. So looking back in summary, we're going to close out the gain amount from the debt discharge. We're going to reduce capital stock based on the negotiation. We're going to close out the loss account that was a result of the asset revaluation. And we're going to adjust our deficit balance up to 0. One comment regarding the loss on asset revaluation. It is possible, I'm going to put some asterisks here, because it is possible that when you revalue the assets, you will actually have a gain. And if we had a gain on asset revaluation, the original entry would have been a net increase to assets on the debit side, a gain on the credit side, and then to close out a gain on asset revaluation, we would have, in this entry, we would have a debit transaction. So there is one amount, there is one of this closeout entry transactions that could be different. The loss on asset revaluation could be a gain, and if that were the case, then we would be debiting the gain to close it out in this final transaction. So these four that we've discussed all balance to excess reorganization value. Notice that the description here at the bottom tells us this is a long-term asset. We don't amortize it. It's something like goodwill. It's an indefinite life intangible. So what you do is you have an annual revaluation to determine whether this asset still has full value, and if it doesn't, then you would have a write-down, but there isn't an automatic amortization of this amount in every period. Now let's look at our comparative balance sheets, same date, pre and post reorganization. The assets, we've adjusted inventory and building up, we've adjusted equipment and patent down, and we've added the new account, excess reorganization value, and I'm referencing the PowerPoint slide where we see each of these accounts, and we now have a new post-reorganization total assets. And then liabilities and equity, again, pre and post reorganization on the same date. The adjustments that we have. Accounts payable is gone. That's been replaced with some other debt and possibly capital stock. Taxes payable, no change. Notes payable gone. Bonds payable gone. Notice that the next three, which are again labeled as post-filing, these were new liabilities, have not changed. And that's the agreement we have with these creditors as well as the employees. These are all forms of credit, and in order to assure the creditors, including our employees who are working and later getting paid, that they'll receive their due in full, we agree to treat them at a higher priority than the other creditors. The next item, notes payable. This is a new item. There was no notes payable in this category. This is a new notes payable prior to the reorganization, and now we have notes payable of $995,000. Capital stock was $500,000, and notice we have two transactions of capital stock. One is $700,000 that goes to the prior creditors who now have some equity. The other is the reduction of $400,000 in the capital stock of the original owners. And the deficit now is a balance of 0. So we're a new company. We're starting over. 0 retained earnings. Not positive, not negative. And again, the PowerPoint slides where each of these is addressed or calculated as listed. And we have total liabilities and equity post-reorganization of $2.2 million. So the company will continue to operate. We've negotiated with our creditors and with our owners to restructure the liabilities and equity side of the balance sheet. We've adjusted our assets up to fair value. We've added in a new intangible asset, excess reorganization value, and the company is going to continue to operate now into the future. This concludes the lecture on reorganization. So we finished bankruptcy, first liquidation, now reorganization, again in class. We'll work through activities relating to reorganization to make sure you understand these concepts, how to work through the calculations, and prepare your post-reorganization balance sheet. I look forward to seeing you then.